Short sellers have had plenty to be grateful for in 2022. Falling stocks, the abrupt end of easy money, and a historic energy crisis. The combination of all of these has catapulted short-selling hedge funds, which profit from a fall in the price of a stock, to center stage, ending the largely barren run they endured in the more than a decade-long bull market. Short selling, one of the hedge fund industry's best known and most controversial strategies, hit high notes during or rather before the bull market, notably during the collapse of banks globally, and also during the demise of technology stocks in the dot-com bust just over 20 years ago. Okay, according to Chris Crawford, he runs he runs a long-short hedge fund for Eric Stotzer Investments. He indicated that his firm have been getting more absolute return from their short books, but according to him as well, the reality is setting in for these companies, he said. And these companies he refers to are the unprofitable groups that investors have rushed into during the bull market. Higher interest rates have raised the pressure on firms whose business models rely on cheap access to debt, while they also make the projected future cash flows of high growth but unprofitable tech companies less attractive, as well as exposing the fragility of companies with appealing narrative but no earnings. The massive shift in interest rates has aided short sellers in other ways. Short sellers who borrow shares that they then sell in the market hold cash with a broker until they close the trade, ideally by buying back the shares at a cheaper price. Higher rates now imply that the interest earned on that cash outstrips the cost of borrowing the shares, according to data from Goldman Sachs, earning them a tidy profit even before any gains on the particular bet itself. The chilling effect of the falling stock market on retail investors, particularly those who raced into meme stock, has also been a boon. Some managers, such as D1's Daniel Sondheim, considered reducing short positions after suffering big losses in last year's GameStop fiasco, while some moved from single stock bets to wagers against an index to curb losses. But many now feel more confident to bet against individual stocks again, according to industry insiders, knowing they are less likely to be targeted by retail investors. Many short sellers suffered in the so-called everything rally during the coronavirus pandemic, when central banks unleashed more stimulus. While this year's 17% drop in the S&P 500 and a 30% fall in the Nasdaq has proved a welcome relief, a declining stock market still carries dangers for short sellers whose pitch to investors rests on their ability to identify the weakest companies. After the golden opportunity presented by the collapse in highly priced speculative stocks this year, 2022, Goldman Sachs' non-profitable technology index is down 60% in 2022. Finding new short trades has become tougher. Managers have also had to contend with vicious bear market rallies, which can shake them out of their positions. The Nasdaq rebounded at 23% from mid-June to mid-August and gained 8% in a week in earlier November. While many stocks have fallen this year, their moves have increasingly become correlated with the S&P 500. Many managers are more exposed to overall index moves. The correlation between S&P 500 and its member stocks have risen sharply this year, according to data from Bloomberg. That has often made life difficult for funds running the so-called pair trades, a bet on one stock rising matched with a bet on another falling, often in the same sector. with plenty of forecasting that 2023 will be another lackluster one for stock markets. Short sellers will be under pressure to prove that they can emerge as one of the few winners. Okay, so see what you make of all of these things concerning short sellers and hedge funds, and thank you very much for watching this video.